Morning, everybody. Today is Wednesday, May 18th. We are live and we're going to talk a little bit about the market rally, but then we'll really spend a little bit more time on what's going on this morning. But yesterday, it seems like the market was really driven by a lot of what's happening in China. We talked about that on the call. And we did squeeze up throughout the day. We had some rallies in some of the industrial names, some of the tech names, a lot of the NASDAQ names did fairly well. It felt a little bit more like a bear market rally, and it seems to be bearing some fruit, unfortunately, on that front today. You also had upgraded guidance from United Airlines. We mentioned on the call yesterday that we did have good numbers on pricing for United Airlines, but we still don't know exactly what was going on with the load factor. Capacity was down, which might suggest that actually fewer passengers are traveling, but the news was broadly taken as really good that they upgraded guidance. And then we had Jim Bullard, who came out at 8 a.m. and we talked a little bit about that, saying that he was only seeing 2 hikes in the next meeting, which seems a little bit more reasonable. And then that all led up to Jay Powell. And after Powell talked, although he didn't really say much of what I consider to be terribly consequential, we'd been drifting around where futures had been for the bulk of the day. And then Jay Powell started talking, and then that's when it gave us our leg higher at the end of the day. So, Tom, you want to talk a little bit about what Powell said?
Yeah, I mean, it was a pretty soft interview with the Wall Street Journal guy who was, I would say, pretty erratic as an interview. But the big takeaway was that, he said there's going to be a soft or a soft-ish landing as opposed to a hard landing or even really a soft landing. So I think the expectation set is that things are going to be bumpy. And I think that everybody kind of has already figured that out. He thinks the economy is still strong. The consumer is still strong. I think there's some evidence to suggest that the consumer is not as strong as we thought. And we'll kind of get into that later in the call. But they said that they need to see clear and convincing progress on inflation before they really stop hiking. So I think the expectation for now is we're just in a cycle where they're going to do 2 hikes at each meeting until something changes. And I think we're starting to see a little bit of a rollover on inflation. Manheim used vehicle index was up just slightly, but on a year over year basis has declined. So in the last month it's up just a tick, but I mean, a very, very small amount from 221.2 to 222.7. But that's against really tough comps where prices were really rising strongly last year. So I think net we're seeing some improvement there. I mean, it wasn't really much to say. We need to get this thing under control. I think there's a lot of ramifications pumping through the economy right now, and we need to get it figured out. So, I think Jay Powell is probably more on the hot seat, I think, than even he thinks in terms of really wrangling this inflation problem.
I think that there was a time period in March and April where I was very confident that the inflation was going to beginning to come down and coming down quickly. I'm becoming less confident in that. The Manheim used vehicle index actually going up in May was a little bit jarring to me. The CPI result that came in last week that was down barely
Yeah.
To 8.2%. I mean, it doesn't even mean anything.
Yeah.
And so that's clearly not clear and convincing evidence. And I think it's going to take some time to get to clear and convincing evidence. The Federal Reserve seems to be confident that it's happening, but I'm wondering if they're kind of a day late and $1 short.
I think if we can see just in economic data coming out today, things that are maybe slightly improving. I wouldn't say they're improving because it's not a great number, but the mortgage applications down 11% month over month, which suggests that there's less demand for housing, which could really, put some pressure on inflation. All of the things that flow through buying a new house. If people aren't moving, they aren't buying new houses. And that slows, that's going to really put a damper on the markets. And then also housing starts were down 0.2% month over month, which is interesting because the survey was actually for negative 2.1%. So we only came in slightly below. So that means that we're still continuing, we're slowing a little bit in terms of how many new houses are being built. But if you have a combo of fewer people buying houses and getting mortgages and more houses being built, housing prices could potentially come down, make things a little bit more fluid.
And we're seeing higher markdown rates at Target and Walmart as well, because they're stuck with a bunch of excess inventory that they couldn't move.
Discretionary spending seems to be cratering.
The housing thing too, the biggest number to me is actually the new housing permits falling more than 3%.
Yeah. That's a huge number.
Big move, especially this time of year.
The National Association of Home Builders, it was crazy yesterday because Home Depot was actually talking on its conference call, talking about the really strong sentiment that it was looking at from its April, from the NAHEB's April survey. And it was all-time high in terms of optimism on homes. That cratered in May. It went from like 70 to 55 or something like that. So we definitely are seeing some softening on that side. And it'll be interesting to see how that ends up filtering through over the next few months.
On the earnings side, we heard from Analog Devices, they're up close to 2%, showing some strength there. Ben, as we think about them and kind of what they said, the big picture, revenue came in strong, EPS came in strong, guidance above where people kind of had them pegged. Pretty good quarter. I feel like there's been periods where we would expect the stock to be up a lot more than 2%.
Yeah, I think semiconductors right now are actually holding up fairly well. For being such a cyclical industry, they're actually holding up quite well. Indeed, we had a big run in the semiconductors yesterday, and ADI going up again this morning would be good news. There is some weakness on the consumer division. We know that, though. Electronics, we'll talk a little bit about Target. Electronic spending is really cratering, especially on TVs and PCs. But industrial semiconductors, communications semiconductors, and auto semiconductors all performing fairly well. And that led to really strong gross margins in the quarter for Analog Devices. They're able to just really lay it on price. So their guidance was good. And they said they do see increasing geopolitical uncertainty and ongoing supply chain disruptions, but they enter the second half of their fiscal year from a position of strength with increased capacity and continued bookings momentum. And that continued bookings momentum is something that's pretty impactful and meaningful to me, because that means that hopefully the commentary on the conference call is going to be good when that starts.
Yeah, hopefully it's accurate. You mentioned Target, absolutely getting walloped right now, down 24%. If we look at some of the high level numbers, it seems relatively favorable. They commented that they're not seeing a sign of a consumer slowdown. May's off to a good start. But this is a margin story, and their operating margin came in at about 65% of what it was expected to be as a byproduct of that. Earnings per share with a massive miss, and not a whole lot of confidence in terms of the operating margin moving forward. I'm stunned, because this has seemed like a company that's operated really well over the last couple of years. A company who started picking up in 2018 and 19. They really handled the pandemic well. They're not pushing through prices, and they're really paying for it, and investors are paying for it.
Yeah, and I think the pricing impact is even less of an impact. That their costs are obviously rising faster than the prices. But what happened with Target is that a lot of those discretionary categories that have performed well, which are higher margin, and they also require those big and bulky items. Think patio furniture, think TVs, think what else did they talk about? Sporting goods. All of that, they really loaded the boat on inventory, because they said, this is probably going to slow a bit, but we still need to be ready and prepared for it. Well, it slowed way faster than they had anticipated. And the problem with those big and bulky items is that you can't store them places, and they don't persist over the season, because you're not going to store them for a year. You're not going to store patio furniture at some warehouse for a year. It costs money to do that. So what they ended up doing was taking massive write-downs, markdowns on a lot of this inventory. And when they did that, that hits your margin, and it costs money to store it. It costs money to mark it down, and it costs money for the freight. And they're seeing some big time impacts on that, as consumers just buy what they need. Food and beverage was up, household essentials was up, and all those discretionary categories were down. And I think it's notable that they did reiterate guidance for the year in terms of their top line, low mid-single digit growth, but their operating margin goes from 8% or higher to 6%, which doesn't sound like a lot, but then you say that's their profit margin, that's going down 30%.
Yeah, I'm super ticked off. I mean, it's wild that this has been a company, and they've been pretty resilient year to date. Up till today, they were down about 7%, which is, nobody wants to lose money, but that's a pretty good performing stock in this market. I don't know. I mean,
you'd love to blame the company on this.
Yeah,
and they would take the fall for it. But the fact of the matter is, it's a recessionary economy, and these MBAs who are just been working there for the last 3 years on their strategy and planning teams, they don't know how to model jump risks. They know how to model trends. That's what they're trained to do. I just finished an MBA program. I know what they're trained to do, and they can't model that sort of stuff. They don't plan for recession. And when it happens, and when it happens suddenly, you can have an awesome, and I still think they do. I think they have a great supply chain. They have plenty of inventory. I mean, that's not
too much
issue.
inventory.
They have too much inventory. And I think that what happened was they got blindsided by the dramatic weakening of the American consumer.
Yeah, I mean, to play Mr. Brightside, I mean, their commentary on the conference call was, we're looking at the long term. Rather than passing on prices, we're going to take the hit this quarter, and we're going to keep on trucking and hope that we can gain market share by having lower prices than other places, and we can eat that cost for now, and in the long term, that's going to pay off. So I think that if that's really, how, not the spin zone and what they're actually doing, I think that's very positive. I mean, I still think that Target has among one of the best in class management teams of any company. It's just, this is a really tough quarter.
I don't know how I'm not going to let them off the hook quite yet. I don't know how you reconcile what happened in their revision on margin guidance with the comment that they're not seeing a sign of consumer slowdown. May is off to a good start. That's absolutely staggering for you to say a statement like that and then say, well, surprise, our margins are 65% of what we thought they would be, and they're going to stay there. Those two things can't both be true.
Well, the thing is, it seems like they're buying other stuff. They're buying low margin stuff, essentials, things where there's no spread.
But that's where it's, if you're Target, I mean, if you aren't being intellectually honest, to use a Matt Burton word, about people are coming in and buying lots of bread and bananas and underwear versus people are coming in and buying electronics, you could spend the same amount. One of those is a strong consumer, one's not.
Yeah. Mm-hmm. And I can tell you from when I worked there in high school, the patio furniture was probably the biggest push outside of Christmas in terms of making sure we got through stuff. Because they would basically take trailers and stack them outside and have them just completely full of all the patio furniture sets. And the goal was to get through those as quick as possible because it was a massive win for the store if you could crush on patio furniture. It was a really, really big push. I mean, obviously that was, let's call it 22 years ago now, but it still was a very, very big piece then. And
it's a high risk, high reward.
Yeah, it's a big piece now as well. I mean, it's super high margin. This stuff is marked up so much.
Mm-hmm. But then if it sits,
then it's wasting space. Your costs go up. Yeah.
Also, I mean, flip side of what Tom was saying on the long term stuff, because I agree with you, Andrew. I think that the consumer is soft. Whatever Jay Powell wants to say. I do think that on the supply chain side, I think that they're in a relatively good position. I think that they are managing for the long term. And I think it's really interesting if you compare it to Walmart. Walmart was really bad yesterday. Target was really bad today. But Walmart actually saw significant traffic declines. Target saw traffic increases. So, Walmart was flat on traffic. Target was up 3.5%. The positive spin on that is that Target's still getting more people into this store. They're clearly executing, at least on some level, fairly well, even with a mix shift toward more essentials when you think you might shift a little bit more toward Walmart. The other thing is they announced an accelerated share repurchase, and they had that planned in Q1, and they haven't executed on it, which suggests a little bit to me. They barely bought any. They bought $10 million of stock in Q1. So they knew this was coming, and it started in March, continued into April. And I think they decided, you know what, we might as well just nuke this quarter, mark down a ton of stuff,
buy back a lot.
And then beginning here in Q2, as we kind of bottom out here, in terms of sentiment, then start to get aggressive on the share buyback.
Yeah, they're going to be buying a lot today.
Mm-hmm.
Lowe's also reported down about 4%. pre-market. I guess the question, Ben, is there anything thematic relative to Lowe's that would surprise people? And we've talked about the retailers, whether it's Walmart, a little bit about Home Depot, whether it's Target. How would you explain their quarter relative to the others, or is it kind of more of the same?
I think it's very similar to what we saw with Home Depot. Talking about tough comps in March, cold temperatures in April, things improving in May, but again, proving to a relatively slow level from a low base. Increased uncertainty on the macro environment. My view on Lowe's is that they didn't have as much breathing room as Home Depot. Yesterday, Home Depot reported and their stock was actually up. But the reason they actually performed okay was because their guidance was so bad 3 months ago because they were so unbelievably conservative. Lowe's wasn't as conservative. Last quarter, Home Depot was down 9%. Lowe's was not down nearly that much. They may have actually been up, if I recall. This quarter, say the flip side. Home Depot paid for it last quarter. They did okay this quarter. Lowe's didn't lower the bar last time. And you're seeing them lower the boom today.
Yeah, interestingly, Home Depot down close to 3% pre-market, and doesn't seem to be based on the housing starts data. It's just kind of trailed off all morning. So retail in general is just kind of getting hammered. We'll wrap it up there. We'll be back tomorrow morning at 8:30. Hope you guys have a great day, and go buy some patio furniture.